G'day guys, it's Nathan here from Galloway. Today our focus is going to be helping you understand and navigate these challenging times and making sense of what it could mean for you as a home buyer. First, it's important to understand the global context here because what happens overseas can indeed impact the Australian economy. ANZ is predicting that significant rate cuts will not happen until mid-2024. They've adjusted their growth forecast for mainland China downwards due to the lack of response in the housing sector and demographical shifts. As the Australian economy is so closely linked to China, particularly in the resources sector, any slowdown in the Chinese economy will affect us here. However, at the moment, we're seeing that interest rates in advanced economies are still rising, and this is despite some expectations on the contrary. ANZ doesn't foresee that the US, Europe, and the UK will start easing rates until the second quarter of 2024, and Australia and New Zealand won't have any cuts until the third quarter of 2024. So interest rates globally currently are looking like to continue to have an upwards trend. For Australia, it's important to consider the current state of inflation. Despite strict monetary policy, inflation remains high and slow to come down. The recent CPI reading showed that unexpected surge in inflation, and this was primarily due to weak productivity and rapid increases in unit labour costs. With wage growth expected to increase in 2024, the RBA is likely to implement further measures, potentially increasing the cash rate to ANZ's peak forecast at 4.6 by August of this year. We've also seen some other economists predict a higher rate peak, and it's really going to come down to the numbers as to how high the cash rate will peak. Additionally, house prices, which we saw drop by 10% early in 2022, once again are on the rise, both due to low supply and high demand. This complicates the Reserve Bank of Australia's job as it counteracts the intended monetary policy. If you find value in this video, please consider hitting that subscribe button as it does really help out the channel, and a big thank you to all our subscribers for your support. Inspires us to create more content we hope you enjoy. Now here's what it means for prospective home buyers. With rates anticipated to keep increasing, you need to really factor this in your planning. If you're considering going for a variable rate, you might need to prepare for higher interest rates and look at interest repayment calculators. We've got one on our website where you can see what it looks like if rates hit 7%, 8%, so on and so forth, so you can get comfort. You might also want to consider a fixed rate. This offers stability in repayments, and you at least know what you're up for a set period of time. Typically, you can fix from 1 to 5 years, so have a think about that. As for the property market, there is upwards pressure on house prices due to low supply and high demand, which is an imbalance that can make it hard to enter the market and make it far more challenging. However, remember, real estate agent is a long-term investment. Consider your own financial stability, your job security, and long-term goals when deciding whether to buy now or wait. High inflation can erode value of money over time, which particularly is important when you have savings, building up a deposit, or especially if you're considering the value of property. While there are challenges in the current economic environment, prospective home buyers can navigate these by keeping a close eye on local trends and global factors, as well as considering different loan options, and have a long-term plan when thinking about their buying perspectives. It's always important to get tailored professional advice from a mortgage broker like ourselves that can review your personal circumstances and give advice as to which way is the best path moving forward. Reach out with us direct if we can be of any assistance. So let's take a close look at ANZ's recent research. We'll leave a link to the report below. The speculation and anticipation of interest rate cuts across various economies continues to loom large. Yet, cuts seem so far off, and this is due to factors such as robust household balance sheets, strong services inflation, and buoyant levels of demand. ANZ anticipates that significant cuts won't be likely to materialize until middle of 2024. The situation of Greater China has been particularly unexpected. In light of recent developments, ANZ has adjusted their growth forecast for China, bringing it down, and they've also brought down their CPI forecast. And the main cause for this surprise comes from mainland China's housing sector, which hasn't responded as expected to the reopening, indicative of a more cautious household sentiment. Adding to this, China's demographical shifts is taking a toll. Over the past 4 years, there's a significant decline in birth rates in the country, and ANZ believes that this demographical shift, coupled with China's debt challenges, could pose a potential dampening on the country's growth forecast. Despite easing measures such as interest rates being reduced, China seems limited in its ability to stabilize its own economy. The International Monetary Fund estimates that China's public sector will require funding amounting to 16% of its GDP this year, and the total debt outstanding at 120% of GDP. This tight situation, along with concerns about stimulating an already inflated property sector and weakening currency, puts China in a challenging position. Meanwhile, interest rate hikes in advanced economies have continued to surpass expectations. We're nearing the end of the tightening cycle, but we're not quite there yet. In ANZ's projections, they don't anticipate the US, Europe, or the UK to start easing until the second half of next year, and even Australia and New Zealand not likely to happen until the third quarter of next year. Only Korea is expected to ease in 2024 in Asia. Technical recessions in economies like Germany and New Zealand have led to minimal impacts on their unemployment, and this aligns with ANZ's predictions. Australia's robust population growth offers some recession protection. However, the conversation around potential recession in economies with hiking interest rates is ongoing. Contrary to this, private balance sheets have entered this tightening cycle in a strong position, without ample time for credit bubbles or excess leverage to build out. Hence, ANZ is anticipating weaker demand rather than the rapid tightening of credit is likely to be the significant transition channel for monetary policy in this cycle. Even though expectations of a recession have risen in the past year, leading to defensive positions by market participants, the data hasn't deteriorated enough to support this pessimistic outlook. In terms of risk positioning, investors are now more defensive than they've been since 2012 relative to the growth fundamentals. Australia is experiencing an ongoing issue with inflation, which remains high and slow to subdue. Despite more stringent monetary policies, it seems that the Reserve Bank of Australia might have to implement further rate hikes. April's monthly CPI figures revealed an unexpected surge in inflation, which jumped from 6.3 to 6.8%. Services inflation is especially robust, largely driven by rapid increases in unit labour costs, which increased 2% in the March quarter. This upswing is less due to wage growth and more due to weak productivity, partly caused by the pandemic disruptions. It's necessary for productivity improvements or a reduction in wage growth to get inflation back to the target band. In periods of labour market where there's weakness, productivity often increases. Wage growth, which is currently moderate, is expected to accelerate in 2023 and 2024 due to several factors, such as governments lifting caps on public sector wage growth, and increases to the minimum wage are expected to continue to increase inflationary pressures. Despite this, ANZ are predicting that the unemployment rate will place a limit on wage growth in 2024. Another challenge for the Reserve Bank of Australia is the rebound in house prices. After a 10% drop in early 2022 from peak levels, prices have risen again in the past 3 months. This increase is due to both low supply and strong demand. This complicates the Reserve Bank of Australia's job as it counteracts the intention of monetary policy. The Reserve Bank of Australia faces a predicament as economic activity dwindles while inflation remains high. The most noticeable slowdown is within the household sector, where mortgage rates and rising costs of living are diminishing real disposable income. It's predicted that this scenario will continue, and households are already reducing their spending more drastically than anticipated. Meanwhile, housing construction is in decline. Despite a sizable amount of work in the pipeline, activity has been decreasing since mid-2021. The Reserve Bank of Australia faces a challenge in navigating a soft landing while inflation lingers and the cash rate continues to rise. This puts the country in a precarious situation with high risk and potential for a recession that can't be dismissed. And remember to like, share, and subscribe to stay informed with all things property and finance. So guys, what do you think? Leave a comment below. We'd love to hear from you. And here at Hunter Galloway, we're a mortgage broker. We deal with people Australia-wide and we'll be more than happy to help. Give us a call on 1300 08 065 or visit our website huntergalloway.com.au, and we'll see you next time.